In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels. Stu, it's that time again.
It's that time again, Bill. It seems like it comes around once a week.
It seems like it's a little more often than every week. But we have another very cool topic for everyone. And this one's a little bit of a surprise as well, because we're going to start giving some hints at some of the things that Stu and I are going to be talking about in Miami, January 29th and 30th.
Yeah, we are.
We have about a day and a half staged by yourself, and we are going to be talking about how professional traders see the trading world. Most people look at their candlesticks trying to make predictions. We want to look at what's causing those changes. We want to see the order book. We want to understand what's happening with the spreads. Why are they widening? Why are they narrowing? Are you becoming a target for being picked off? We want to look at all of the what's called market microstructures. So if you're interested in that, we'd love to have you January 29th and 30th. And I'll give you the website and the number here in just a moment. So anyway, as a little precursor to that, Chalk Talk. If you roll a spread for a credit, everybody loves their credits, right? Are you getting paid for a new spread? So the idea is that we've got the 100-105 spread, and I roll to the 105-110. Market's moving in my favor. I just roll up a notch, one strike up. We get a credit for that. And people say, well, I almost recovered all of my initial cost, or maybe more than that, and I also have now a spread. It's like I got a free spread. And that's the question we want to address. So think about that for a moment. How have you been trading it? What have you been told? And then let's take a look at what's actually happening. So ready for this, Stu?
Let's do it, my friend.
Here we go. So rolling vertical spreads. Let's say that you buy the 100-105 vertical spread for 2, and you roll to the 105-110, and you get a 60-cent credit. And so you'd say, okay, and then we roll to the 110-115 for a 60-cent credit. And then to the 115-120, we keep getting roughly these 60-cent credits, 120-125. And suddenly we go, look at this, I've got a credit of 240. I paid 2. I'm into it for no cost, and I still have a spread. What could be better? House money, we hear a lot of people talk about that, which is not true. This is always your money. And the question is, in this case, is this a free spread? So we have a guaranteed gain of 40 cents. It's a very easy trap to fall into. We see people do it all the time. We spend so much of our time in Q&A explaining this and re-explaining it to people why that is an illusion. And that's what we want to share with the rest of you. And before we do, I've mentioned the website and phone number. Please join us, marketrebellion.com/get started, right there on the screen. When you go to that page, the phone number will be there if you want to join us in Miami. If not, lots of free courses and videos right there on topics just like this. So great place to get a firm foundation. So let's look at this here. We've got the 100, 105. Remember that this is, we always get bends at the strikes. There's the 100, 105. We have limited loss down here, limited gains. And then we roll to the 105, 110. We get a credit. And what traders see is that, I've lifted up the maximum loss. And that's all they look at. And they say, I'm getting paid and I still have a spread. Whether it's on the black spread or the blue spread, a spread's a spread. Not true, but that's the way they see it. And they see that they're getting all of these credits. They get maybe another roughly 60-cent credit. Incidentally, the spot where all things equal, where you're going to get the maximum credit is at the strike of the short. So in that first roll here, when the stock gets to 105, that's when most traders would perhaps roll it up. And so they keep doing this, and then all of a sudden one day, here they are. There's zero. The entire green curve is above zero, so they go, I can't lose. I'm a genius trader. I've collected all of these credits. I've annuitized my spread. We hear that a lot. And I'm generating income from my spread, and I still have this free spread. It's kind of hard to argue if it's cast in that light, because that's what it looks like. And that's why so many traders make mistakes. Now, what we're going to show you here, I'm going to mention it a lot of times, this does not mean it's wrong to roll a spread. It's wrong if you're rolling it for the wrong reasons. If you think that you're getting some type of credit and getting paid for it, and that you're getting this free spread. So what's really happening here? Well, we start off with the 100, 105, long the 100, short the 105. And let's just think about it in steps. If we had to piecemeal our way through this, what would we have to do if we wanted to roll this? Well, I'd have to close the 100 call, and that's going to shut that down. Then I'd have to buy back my short 105 call, right? That closes those. And then I'd have to buy the 105 call and then sell the 110 call. And I would be long the 105, 110 vertical spread. And people say, oh, everything else is gone. I'm just long the 105, 110. Again, it's an illusion because we've talked about this before, what we call phantom trades. Now, because of the OCC, the Options Clearing Corp, they require that we net these out. You can't be long and short the same contract in the same account at the same time. So if you're long the 100 call and short the 100 call in the same account, they go, nope, got to pretend that they're not there. We net those out. And that's really what causes the illusion. People think that that's gone and this is all they're holding. And here's why. Where's our phantom trade here, Stu? Let's just focus on these four, which are the four, let's call them like Lego pieces that we had to click together to get us to that roll. Well, what would happen if we stuck this in here, marketrebellion.com/get started. Another quick little blurb for you there. Please check us out there. Phone number 2 if you want to join us in Miami. So if we do that, what happens? We end up, if we pair these things up, that's a butterfly spread. It's a short butterfly. See, we were previously long 2 of the 105s. We're just going to kind of combine them. We're short the 100, 2 long 105s. Or long 2 105s and short the 110. Those three right there are a short butterfly.
So, Bill, are you saying that the stock was 100, now it's 105, and now we're going to be long the 105s instead of short the 105s?
That's exactly right. Yep.
And now we're long the risk line.
We're long the risk line. Yeah, very good. And that's actually a good insight because we're going to come back to that in a moment. That's another little trap that people fail to consider. But what you've done is you've sold a butterfly. And again, even though you're going, I don't see a short butterfly in my account, that can't be true. Mathematically, it's true. It's this netting process that the OCC requires that they get netted and you don't see it, so it looks like it's not there. But what you could do mathematically, if the OCC did not require that these things get netted out, is you could have the 100, 105 call forever, and you would see a series of butterflies. Well, if you're selling a butterfly, ask yourself, is that an asset or a liability?
Yeah, it's pretty interesting. So think about this, everyone. Like you sold it. Why didn't you just buy the hundreds? Well, I'll have this conversation with myself. Well, because I didn't want to pay the theta. Okay, so let me sell the 105s.
105s, yep.
All right, so now I'm going to reduce my theta. Okay, fine. So now I do what you're doing here. I sell the fly, and now I'm long the 105s, and now I'm long the gamma. Now I'm long. Now I'm long again. Right. So I set out to not have theta, and now what I did was I created the theta.
You created the theta,
I
exactly
don't
what you
I
were
don't
trying
get
to
it.
run.
What am I
Correct.
missing here, Bill?
Right. No, you've got it. And I knew you'd get it, but most of them won't. And what we want to show you, Stu's exactly right, that you're trying to get away from that risk. But when people see dollars as risk, they see that, oh, I'm lifting the lowest part of that risk graph up and therefore I'm reducing risk. No, you are not. You are increasing the risk, and that's why you might make more rewards. So, oh, sorry about that. So, anyway, let's go back to our uh, spreads here. And actually, before we do that, I'm going to bring up an Excel sheet to show everybody where these are coming from. Let's pump up the
And let me add
fonts
while
a little
Bill's
bit.
doing that. Let me add that this is any rolling conversation that you could have.
Oh, yeah.
Well, you are when you roll, you are getting paid, and that's what people see.
Yeah, that's what they see.
What you don't see is that you're buying. Like if these are calls, what you don't see is that you're buying the put spread,
Right.
and and that's a cost, right? And we've actually done a coach's corner on that, haven't we, Bill? Like, what is the
Oh, yes, we
cost of
have.
rolling? There's a cost in there. You don't see it because all you do is you see the dollars. You are changing the dynamics of your position. You are getting away from the very thing that you set out. You are
That
getting
you
back to the very thing that you set out to be away
That's
from.
exactly right. That's what they don't see. You think you're running away from the risk and you're running right into it. And
Yeah.
again, that doesn't mean it's bad
No.
if that's what you're trying to do. So take a look at this. These are Black-Scholes prices for the 100, 105, 110, and 115 call. We have the stock at 101, 20% vol, no interest, and 0.16 years, which is 60 days. So just take a look down here. The 100, 105 vertical is $2. I rounded down to make it easier, but that's where I got the $2 from. And so what happens if the stock goes up, let's say to 105, but it takes 30 days to do so. So let's change our time down here to 30 days. And now we say, all right, now my vertical spread is 324. There's the 100, 105, but I can sell the butterfly for $1.56. I can get this credit. And the thing that they don't really, they say, I'm shifting up the maximum loss and I'm getting this credit and I still have a spread. You're not realizing you're giving up 324. That's an accounting deal, debits and credits. The economics of it is that you are saying, I don't want the 324 for sure. That's a choice. Don't forget that. That is a choice. And instead, I'm willing to take this $1.56 credit. And now I'm into the 105, 110.
Bill, are you saying that I could hit the send button and receive 324?
All you had to do was hit the send button. But because they just see, hey, wait a minute, I can get paid. I can still keep a spread, not my spread, but a spread, and I can get cash. I'm annuitizing it and I still own a spread. See, the whole thing's an illusion. What you're doing is you are selling butterflies. And so that's where these numbers are coming from. So if we go back to the presentation here, there's our 100, 105 for 2, max gain of 3. When you sell the butterfly by itself, if we overlay it, this is what it looks like. So remember, the stock is here at 105. What do you see in here, Stu? Looks like a big pit to me, a big area of risk.
Which should make sense to everybody because what are you doing? Now you're long the 105s.
You're long the 105s, exactly where the stock is. Now, this is again because we don't see this happen. The OCC requires us to net them. So if I take the black curve plus the red, we get this. And this is where traders say, I've got this I've got this 40 cent roughly loss, right? I paid $2, I got roughly $1.60 back. I've got a maximum loss of 40 cents. I'm a genius trader, and I've also increased the maximum gain. Again, it's an easy illusion to fall into. Let's compare it. Here's how we find out what's going on. Let's go back to the original spread, 100, 105. And what do we notice, Stu? Yes, it is true that you lifted the bottom here from the black to the red, but that doesn't mean
which is a
you've
good thing. I mean, you can't argue with that.
well, it's not good or bad. It's just different. We've changed the risk profile. It's not like somebody said, would you prefer to take $1.56 or not, and it keep everything the same?" You haven't kept everything the same.
No, you haven't.
And
No.
so what's happening here, if we look at if we hadn't changed anything, the stock is here at 105. And what do you notice? That's the area of maximum gain. We're away from
You're
theta.
giving that up.
And you're giving that up, and you're saying that we
You
are
need the
now
stock to go higher.
choosing to put ourselves at the area of maximum loss. That's not the same deal. And once again, I'm going to keep repeating this. It doesn't mean it's bad. It's bad if you think that it was just $1.60 for because the market wanted to give you money and you're a genius trader. You are simply selling a butterfly. And that is why we have more potential reward and a smaller loss. Why? When you have higher risk, you have smaller prices and higher rewards. That's the illusion of the role, is that you are just changing the risk reward. So again, not good or bad, but where it becomes bad is if people say, you know what, I'm really a little fearful of this for whatever reason, or it's exceeded my goals, but let me roll it because I can get some cash and I still have a free spread and I'm just playing with house money. That is absolutely not true. There is no such thing as house money.
Yeah, get away from this whole free thing.
Right.
It's not free.
There's no free.
There's
Markets are
always a
not here to
cost
give
to
you free
getting
money.
something. Yeah, if you want to, if you really need or feel the need to say that, add on. Yeah, maybe it's free, but there's a cost to it being free.
Yeah.
You
There is
know, I mean,
you have
that
to say,
sounds a little
why
dumb.
did the
It's
market
like,
pay you that? Why did the market give you that credit? Right? What would you do if some guy walked up to you on the street and said, "Hey, would you like this $100 bill?" You don't just go, "Cool, free money, thanks." You'd say, "Well, you're not. Nobody hands out free money. What do I have to do for it?
right.
What's the catch?" And you need to take the same approach when the market says, "Hey, here's a big credit." Well, why are you offering that credit? What the credit is doing, what the butterfly is doing, it's removing. Actually, first of all, yes, we can see that the new red curve sits higher than the black above this crossover point.
Mm-hmm.
That's a benefit, all things equal. And we can see that it sits above the black for below this crossover point, right? And that's a benefit, all things equal. But what people fail to recognize is that in this area, or kind of rectangular area right here, that the black sits above the red. And there, the spread outperformed because we were already at maximum gain. If we just sat there and did nothing, assuming the stock price stays the same, we were going to move from 3.25 to 5. $3 profit, but a total value of 5. Whereas here, we're moving to maximum loss.
Yeah, but Bill,
Two different things.
if I have a stock that goes from 100 to 105,
Mm-hmm.
I'm going to be my usual JO self here.
I know where you're going.
Like, why would I not think it can go to 105 to 110?
It can, but it can also go back to 100.
And then I'm going to be pissed off, right? Because I didn't do anything,
or in that case, you might be happy because you'll say, "Okay, I've minimized my loss," but it could also hang somewhere in this range, and that's not a trivial range right there.
No, not at all.
That's not a trivial range, and that is most likely where the stock is going to stay. So think about this. The reason you got paid for the butterfly is you say, "I want to give up this area and transfer it over here, which is riskier." And if you have that perspective, then I'm okay with it. It's just a matter of what you want to do with your money. But you're not getting paid to take a free position and still have a free spread on. And that's really the thing. And that is really true of all roles. They are a transfer, they're a reshaping of our risk reward profile. And we still hear so many people in Q&A say, "Oh, well, I rolled and got paid," or "I rolled and got a credit." Okay, what's the rest of the story? And if you can't tell the rest of the story, hit the brakes and say, maybe I shouldn't do it, or maybe I should get some training until I can explain part B. Part A, yes, you did get a credit. Part B, what did you give up for it?
Do I want to own the intrinsic or do I want to own the extrinsic?
That would be a good starting point.
That's a conversation you can have with yourself.
Yep. And I
Which one
noticed that
is
in
it?
our
Am I trying to move away from paying theta, or am I trying to take on paying theta in return for watching
Mhm.
the stock take off?
and
Again.
again, and Stu knows this all too well in our ICF instant cash flow service. We've had many conversations where we say, should we take the roll? We can get a $4 credit for a $5 spread, and Stu will say, do we want to pay the dollar?
Yeah. Yeah,
And
right.
people go, what do you mean? We're getting a $4 credit?
Yeah.
Yes, but synthetically you're paying a dollar. And if you can't understand that or explain it, you got to be very careful about rolling for credits and thinking that you're just getting paid and that the market is suddenly this big ATM machine. The reason for the credit is you are shifting to a riskier position. Once again, it's not wrong. Just make sure that you understand that. So here's a good little analogy I've used for traders before. So let's say we've got this busy highway here, and you are standing right here, Stu, at the right in the center of this lane. So that's like being right at the strike, at the 100 strike when we bought our 100 105.
Okay.
Not a good place to be. We can see this guy's about ready to change lanes here. Very
Mm-hmm.
dangerous.
Mm-hmm.
So Stu is trying to dodge around, move. This is like the stock price moving up and moves back and moves in, and pretty soon he gets out here. Now, this grassy strip is our maximum gain. So where's Stu standing right now? Relatively speaking, pretty safe.
Good place. Yeah, I like
And in
that
fact,
place.
if he stays here, he's going to automatically drift here with 100% certainty.
Yeah, I'll be around for dinner.
So you're saying, okay, but now somebody comes along and says, "Hey, Stu, for a buck 56 or buck 60 roughly,
Yeah,
I'm going
right.
to automatically
Go back.
teleport you back there."
Yeah.
And you go, "Okay, hand me the money." See, it's not free. You have to understand you are recentering to a riskier position. That's the catch. And if you don't see that in any of your rolls, we're not just talking about rolling verticals. That came up recently. That's why we decided to talk about it. But rolling calls, rolling puts, spreads, butterflies, rolling the long position up on a wide strike spread, it's the same story. It is it's a reshaping of your risk reward profile. It is not free money.
And again, to reiterate what Bill's saying, it's not a bad thing.
It's
It's
not a
not
bad
something
thing.
that you should say, I'm not doing it.
Right. We're not
You
telling you to
do
not do it.
you pay for something. It's not free.
That's
That's the
right.
point.
Yep.
You're not getting paid for nothing. You
Right.
get paid for taking something on. And
See
you
what
have to
people
know what that is.
Yeah, what people think back to this analogy, well, I'm standing here and somebody's going to pay me and give me a new spread and I'm still standing here. That's the catch. No, somebody paid you to do what? To
To
shift
move
back
over
over
there.
here.
Yeah.
That's the question that you have to address. Now, depending on markets, skews, a million other things, that might be a phenomenal deal.
Might be.
But what we find so many people, and it might also be a phenomenal deal to say no and to stay where you are.
It
That's
might
the
be.
trading decision.
Yeah.
How do we play the cards that are in front of us, not the cards that we want? But if you are one of these people that says, "Oh, I can't wait to roll so I can get paid or I can get a credit," hit the brakes. You need to understand that is not what's happening ever. So hopefully that gives you a little kind of a good analogy and a good
Yeah.
visual of what's happening with those spreads. You're simply recentering the risk. And when you do that, if you're accepting risk, what does the market do? Pays you. That's the only time that the market pays you cash, Stu, right? For an opening trade, not for a
I
closing
think
trade.
so.
But for an
Yeah.
opening trade, you have to accept risk.
Mm-hmm.
Why did you get the credit? Good question. Maybe there's some risk in here somewhere, and that's what you have to answer. So hopefully that helps everyone. So let's go ahead and answer our chalk talk. If you roll a spread for a credit, are you getting paid for a new spread? A little bit of an ambiguous question, but I think you know where we're heading with this. No. You are receiving credit to reshape your risk profile. You are stepping into a riskier zone. You are not just saying, we're going to swap out. It's still the same spread, but we're going to just throw some cash your way. Very dangerous way to approach it, and we hear it all the time. So remember that, and that's going to make you a better trader coming into the new year, and that's what it's all about. So with that, I want to thank all of you for being here, and we hope to see many of you in Miami again, January 29th and 30th. We're going to have a phenomenal day and a half, just Stu and me on stage doing incredible demonstrations. People, you can place markets, bids and offers on your phone. It's going to be a live demonstration of market microstructure.
A lot of
It
fun.
happens at the limit order book. We're going to look at Nash equilibriums, Schelling points, the marginal pairs, who controls the book. You're going to understand what's creating the candlesticks that you see. When you do that, you're going to be in a whole lot better position. So with that, thanks for joining.
I thought isn't the scumbag market makers that control the book?
That's what everybody thinks. We're going to have some very jaw-dropping moments in that presentation. Lots of fun stuff. So we hope you can join us. And if not, we'll see you next Thursday for Coach's Corner. We'll see you then.
Yep.